Guys, appreciate the time this morning. And I guess I wonder where you think we are in terms of positioning and sentiment and how important 3,800 is, not just today, but for the medium term.
Well, markets don't feel good right now, but as you all have been talking about, not just today, but for many, many weeks, it feels like there's been something missing, and that's really that final fear, that rip the Band-Aid off moment, where you see strong, sell-off on speculative assets. And we're starting to see that today. That can bleed in and affect other asset classes as well. But when you get that, when we see that, there's real opportunity. And if we don't get that, more importantly, we are seeing some opportunities today. So we're starting to pick away. Also looking at portfolios, trading to make sure we have the right securities to own going forward, because the regime has changed and it's a different world out there now.
Michael, do you think we're over our skis and Fed expectations?
Well, I think what's important here is that despite the decline in equities that we've seen, despite the decline in global growth, weakness in the housing market, a weakness in consumer sentiment, it has not been enough when it comes to slowing inflation. And that's what the Fed's focus is right now. There's certainly trade-offs for the Fed between growth and inflation, but their focus right now, we think, needs to be on the inflation front. And inflation continues to surprise to the upside. And if they don't come with a bit of shock and awe, the market may expect that they continue to stay behind the curve, and inflation continues to run to the high side.
So are you saying that if they do go 75 basis points, which would be a surprise, Michael, especially since Fed Chair Powell ruled it out, and I know you guys at Barclays are now expecting it, that would be like a buy the news event, because that would lead to the market eventually thinking that inflation is going to seriously come down because the Fed is even more bold?
Well, Sarah, less of a surprise than it would have been on Friday. The market's now pricing in a 75 basis point move at one of the upcoming three meetings. So it's more of a timing issue at this point. But again, the market's priced for inflation, CPI headline inflation, to peak at 9.3% and not until August. So the market's still pricing in very robust inflation, only dipping down below 8% by the end of this year. And that's why we think the Fed needs to come with more and maybe surprise the market a bit. But as I already said, the market's already done a lot of heavy lifting since that CPI report came out on Friday morning.
I just don't think this is the Fed that's in the business of surprising, but maybe they'll surprise.
I don't think I certainly don't think they want to. But given the inflation readings and the uptick in the University of Michigan Consumer Sentiment indicator on long-term inflation expectations, which have now reached an uncomfortable level from their perspective, we think they need to do something that they wouldn't have thought about a couple months ago.
Shepard Smith here. Thanks for watching CNBC on YouTube.